What's up, outliers? Quick market update specifically on GameStop. Actually, I'm going to start doing a few videos per week covering a couple different covered strangles that I trade. And as we discussed in the introduction video specifically for GameStop, I have an allocation of the portfolio that I'm using to trade a covered strangle in GameStop. And then I also have other ones in some leveraged ETFs, IBIT for Bitcoin, and those will be separate videos. So the goal for today is to walk you through some updates on the position as it sits, do a quick overview of what seems to be going on in GameStop, because I had a really good day today, especially with the rest of the market showing as much weakness as it did. GameStop is genuinely showing market strength, which is very, very cool to see. So from a quick technical overview, looking at a 6-month daily chart, that's what's up here now, we can see that it's been just kind of running up along this trend line for a little while now. And it's progressively posting higher lows and higher highs, which obviously is associated with an uptrend. Now, one thing that does stick out to me when looking at GameStop specifically is this trend line is really steep. What I do for things like this is I monitor the relationship between the trend line and the standard deviation channels or linear regression channels, whichever I happen to have up at the time. And I look at the slope in comparison. The reason for that is because when we tend to see, I guess I tend to see, these kinds of more aggressive moves, they generally will be followed by a period of consolidation. And the reason for that is this is a really aggressive growth trajectory. If we take a look from fall of last year, it was around 2053, and as it closed today at 3337. That's a big move for just about any company over that time frame. So this is an aggressive move. Now, GameStop does tend to move a little bit more aggressively than other things that we might trade on a more regular basis. And to demonstrate that, though, I want you to take a look both at the average daily range and the average true range. Again, for a quick reminder, average daily range looks at the move of the day, and then average true range encompasses the overnight gaps between days. So the 5-day average daily range is 6.47%, the 20-day is 6.6, and then the 90-day is 5.98, so about 6. What I'm showing you is that this has become slightly larger ranges as we get shorter on our time frame that we're looking at. That tends to show a little bit of volatility entering the picture. This isn't significant because the difference between the 90-day and the 5-day isn't massive, but still, that's something I pay attention to. And then the same thing when I look at a 90-day average true range, which is 4.65% against the 5-day, which is 6%. So this is demonstrating that very clearly the near-term time frame is more volatile from both a price general trend perspective, but then also from an actual daily price movement perspective as well. So there's not a whole lot to take away from that other than bolstering the fact that this is continuing to be an ideal candidate for something like the covered strangle, which if you're not familiar with what that strategy is, I encourage you to check out the video in the description below. That's the introduction to this series so that you have an idea of what I'm going to be talking about in a minute. So the implied volatility is 117%, very, very high. And on a relative basis, 58%. So also relatively high on a relative basis. So it tells me that we're still seeing pretty significant volatility, even though there's not a whole lot coming up like right now. Obviously, we will be coming into earnings in a couple months, but we still have a bit of time before we get there. So this is a little interesting that it's that volatile with not a whole lot on the radar right now. We can see that the 17 Jan 25 expiration is at 140.6% vol, and then it dumps after that, 123, 124. This is the market telling us something is going on here. I don't know what it is. I can't see it right now, but I can tell you that the market is telling you something is going on here. So it's something to be aware of. Maybe you all know there might be an announcement coming out. I haven't looked too far into it yet. I'm still getting caught up from coming back from traveling and whatnot. So I haven't done a bunch of deep dives on the typical names I follow. Maybe you can get me schooled up, but something's going on. I can tell you that the market is pricing something in. So that's kind of the cool part again about options trading, is that you don't necessarily have to know the details of everything to be able to see that something's going on, which is clearly the case here. Now, call skew is huge. 896,900 calls against 278,000 puts. That's massive. That's almost a 3-time variance between these. It is essentially a 3 times variance between these. Normally, this will hover around 2. So there is undoubtedly a lot of action coming into the call side. And I want you to notice the colors of these little rectangles. You see how they're like that neon blue? That neon blue is 17 Jan. The same expiration that seems to have really high IV. So one of the reasons why 17 Jan might have elevated IV compared to the others, at least part of it, will be because of this, because there's so many options in that expiration on a relative basis. Let's take a look. 17 Jan has over half of that options chain. So if we look at all series, there's 897. And if we take a look at 17 Jan by its very self, it's 477. So that tells you a lot. And that's absolutely going to be a contributing factor as to why we see this being as elevated. Now, it might be confusing because the colors change when I flip back and forth, but now it's the purple that is 17 Jan. So I find that generally interesting. Now, let's talk about the trade that's sitting right now after some adjustments today. And I want to walk you through what I did and why. Now, first things first, following up on, I got to move this over a little bit so you can see here. So following up on the stream from Saturday when we did the GME stream, I had asked, what allocation should we use? I originally had earmarked $15,000 because from prior conversations that seemed to have been closer to like an average GameStop holding size. And then when I did the poll on this Saturday, it was 25K, was a little over half of the submissions for people. So I've bumped up the allocation to 25K. And I'll continue to modulate this as we go. But one note I want to make abundantly clear, the base position that I originally started using, I'm not going to continue pulling from my existing shares. So I want to explain this to you. Right now, if you just pretend over here, I have a bucket of GameStop shares relative to my overall portfolio that's buy and hold, designed to just sit there. For this exercise, what I've done is grab a portion of this, and this is the allocation that I'm using. So the 200 shares are part of this broader holding that I've alluded to before. But when I'm manipulating this going forward, like today, I am not going to continue tapping into this existing pool of shares because that doesn't represent the actual strategy and what it would be like to actually run the strategy as of today. So for example, when I bought the 100 shares today in GameStop at 32.23, I've added more. This is a net new add to the portfolio. So I just want that to be really clear as we're going forward. This was pulling from a portion of an existing holding. Everything going forward from here is going to be whether we're adding or subtracting based on what's actually happening today. And that's just so it's more efficacious for you to follow along, right? Because if somebody's trying to figure out what I'm doing, they're like, well, I don't have shares like this to be able to pull from, which I understand. It wouldn't be a great example. So I'm just clearly delineating that this was just to start the position, and then everything going forward now will be added or subtracted just as I would on a standard open market. So all that being said, that takes our current holdings to 300 shares at $26.95. I'm actually not super jazzed to buy a bunch of shares here, but I need to scale up. So that is what it is. And when I say that, you can see originally I was configured for $15,000. So I think the utilization was like 12 or 13K. But now we're at 17K, and I need to move this up just a little bit more, which I'm going to explain how I've done that through this here. So We are 67.5% utilized. The base position via shares is set. And we have two different expirations now of short puts. These are cash secured. We have the 21 Feb 28s. We have two of those. And we have the 10 Jan, which is this Friday, the 32s. So notice the difference between these two. This is literally a 3 DTE trade against, I think this is using different years. That's probably why it's confused. Yeah, so this would be 24s when it was entered. That will fix that. And you can see this is really short term, and it's also a much higher delta. I entered this one at a 25 delta, entered this one at 44 delta. What am I doing here? I'm actually trying to get assigned. I'm putting on a trade that is essentially at the money with the expectation of getting assigned. That's the game plan right now. So if we float into expiration and I get assigned on these, great. If I don't, that's okay. I'm going to lay them out for the next week at the money again. And this is a way for me to receive a pretty healthy premium relative to the time frame, right? Because take a look. This is giving me $2.87 per contract for a 52-day trade. This is giving me 95 cents for a 3-day trade, but it's because it's such a higher delta. So on a relative basis, this is paying me really, really well. And this goes back to that example I was just giving you. We go back here to this up here. The volatility is very high. So that's why I'm not buying the shares outright as I typically would. I did already to start scaling up because I was grossly underscaled. But instead of buying 200 shares or 300 shares, I chose to buy 100 shares and then sell at the money puts with the intention of getting assigned, but I'm going to capitalize on the volatility until that happens. And then we will continue to play the game. Now, the other thing I'm going to do is probably sell one more short call. So I have 300 shares and I only have one short call. So it's a 3-to-1 ratio, which is about good for a longer term holding. For something like this, I really want to capitalize on this volatility while it's here. So to do that, I will ratchet up that ratio a little bit. So it would be at a 2-to-3 or 3-to-2, depending on what you're looking at first. Shares 3-to-2. So I would have 300 shares against 2 short calls, maximum 200 short deltas. And the intention is not to get assigned on those short calls. So they would be managed against the long shares via aggressive management, meaning I'm paying close attention to it. I'm not just letting it go and seeing what happens so that I don't get assigned. The risk is that I could get assigned early. That is a thing, especially if something like GameStop squeezes while I'm in doing this and I have short calls. There is absolutely a potential for somebody that's being squeezed that has those calls to exercise them early. That's the risk that I run, and that's why I'm not trading it at a 1-to-1 ratio. I don't want to unwind the whole position. I don't even want to unwind 2/3, but I want to make sure that I'm trading in and out of this thing so that we can generate as much money as we can based on where GameStop started the year, which I'm going to track right here. And we will see how we are able to progress. So far, the trade is performing really, really well, where on a return on an invested capital standpoint, meaning we're using this 16.8 for the basis, it's returning really well. We're sitting on a total P&L of $3,000 on, again, total allocation of now 25K. It was 15K right before this. So this really is starting to progress pretty well. And it's perfect for this kind of market that we're seeing in GameStop. Really high vol, not massive price movements yet. And that is the game plan going forward. So my hope is to continue sharing updates like this. I hope it's useful. And as I'm doing these, if you have questions, please ask. It's the entire purpose of me doing this. I already know what I'm doing. I know how to do all this stuff. It's what I do for a living. So this is really to try and share some of the skill set of options trading with the GameStop community, just to give you more tools. Not saying this is the right way. This, again, to be very clear, is not exactly how I would trade this in a nutshell. I have other things that I do in something like GameStop, specifically volatility related, for more directional plays using single options with kickers and stuff like that. But those are different strategies. This I chose for this series because it's based around a buy and hold position. which I think most people that trade GameStop like to maintain something like that. So I thought it was relevant. If you have any questions, let me know. Be an outlier. I'll see you later.